Okay, so the macro landscape obviously politically is a bit difficult, and we've seen that with the US election. We're going to see that in Europe with regards to Brexit and the resulting effects that occur around Italian referendums, French elections, German elections. Interestingly, in the background, the macro is actually probably looking a bit better. Obviously, you have emerging markets that have been very weak for a long time, are bottoming out and getting better, mainly in response to the fact that the dollar's managed to stay weak. And then also you have Europe that's essentially bouncing on the bottom, getting slightly better. And ultimately, if you put all those macro pieces together, we see probably better macro momentum like next year. And if you convert that into earnings, you have commodity prices that are bottomed, potentially going higher. You have a lot of the people who've serviced the commodity industry have bottomed, potentially going higher. And then you have banks and other industries essentially coming off the bottom as well. So ultimately, it's a slightly better year next year macro, and mainly because it's just less bad. So for growth investing, we have to balance a couple of issues here. One, economically things are better, or at the margin better than what we thought. Not discounting the political issues, which we've obviously seen this week with the US election. But discounting political issues, growth is getting better. The concern there is, unfortunately, interest rates are going up as well, and it looks like interest rates are bottomed globally. And so from that point of view, while earnings get better as interest rates get up, sometimes the multiple, particularly in the higher multiple stocks, goes lower. And we've seen that happen to yield stocks, we've seen that happen to consumer staples, and we're now seeing it happen to growth stocks and small caps as well. And that's just something we need to be careful of. So we need to be much more vigilant about the multiple that we're investing in and the earnings upside that we're getting, if that makes sense. A bit of both. So obviously we're looking for earnings growth, generally sustainable earnings growth, but earnings growth is a good place to start, and then being more vigilant about the multiple you're investing in. And so from that point of view, we're probably going into an environment where inflation's rising a bit and interest rates are rising a bit. So being able to protect against inflation is probably the most important thing, to have pricing power, to be a beneficiary of rising inflation, and then also to be careful about the multiple that we're paying for it, or more so than we have been as interest rates went down.